In today's video, I'll explain my thought process when choosing funds to buy and the factors I put into consideration before I pull the trigger on what to buy. I'm a global and somewhat lazy investor, and I'll continue to be a global investor for years to come. But I'm also aware that the investing options are enormous and could be confusing. Vanguard Canada has 43 funds, while BlackRock Canada has 161 funds to choose from. There's a lot to filter through and nearly impossible to buy all these funds. So there has to be some criteria to cut through the noise and zoom in on what is ultimately beneficial to your pocket and portfolio. This is a simple analysis that you can go through as well, so you're confident in the investing decisions you take. At the end of this video, I will share 3 ETFs that meet all these criteria, so make sure you don't click out. This video is timestamped as usual, and you can skip around to the section that most interests you. First and foremost, any fund that I want to invest in needs to be passively and not actively managed. If you've been around on this channel long enough, you will know that I am very hands-on with investing, and I do not want anyone buying funds or managing my portfolio, my investment portfolio on my behalf. The biggest difference between active investing and passive investing is that active investing involves a fund manager picking and choosing investments to buy or to have in your portfolio, and this comes with high fees. Whereas passive investing typically tracks an existing group of investments called an index. The reason why Jack Bogle, founder of Vanguard, created index funds and index investing in the 1970s was to make investments simple, easy, and low cost for the common investors like you and I. So instead of you paying your fund manager 2%, you can simply pay a tenth of that in expense ratio with similar returns between passively and actively managed funds. The S&P Dow Jones team looked at 2,132 broad, actively managed domestic stock mutual funds that had been operating for at least 12 months as of June 2018. The team selected 25% of the funds with the best performance over the 12 months period through June 2018. Then the analyst asked how many of those funds remained in the top quarter for the 4 succeeding 12-month periods through June 2022. Not a single one of the initial 2,132 funds managed to achieve top quartile performance for those 5 successive years. So despite the expertise, the tools, the research, and all that, non-managed or passively managed index funds beat all 2,132 actively managed funds. The fund sheet of an actively managed fund clearly states who the investment advisor or portfolio manager is, while a passively managed fund states the index it tracks and it states that it is not actively managed. I show side by side what this looks like. VADGX is actively managed, while VFIAX is passively managed. Why would I risk active managed funds with its high fees and no guarantee of high returns when I can pay relatively lower fees and the track record shows a good past performance for the alternative? Any day, anytime, I will always go with passive funds. Okay, the next criteria for the ETF is that my portfolio needs to have a global exposure with ETFs in both emerging and developed markets. I have an inside joke when people ask me where I am from. I simply say I'm a global citizen. And this is the mentality I carry into my investing strategy. I don't have a crystal ball to tell me what economy or what the economy will be like in 20 years' time. And the only way to hedge my risk is to have international exposure. Developed markets are countries that are most progressed in terms of their economy and capital markets. So examples of developed markets are the United States, United Kingdom, Japan, and Australia. On the other hand, emerging market economy is the economy of a developing nation that is becoming more engaged with global markets as it grows. So simply put, it's a growing market. The biggest emerging markets are India, China, Brazil, Russia, and South Africa. Since I am young, and I believe most of the people watching me or most of my viewers are also young, we have time, or we have the time advantage to allow these emerging markets to grow and we get to benefit from that growth. They are emerging markets today, but guess what? They won't be emerging markets forever. And they will also grow to become developed markets. On BlackRock's website, you can filter ETFs by markets and regions. So if you want to see emerging market ETFs, you click right here and you have options to choose from. Also, you can filter ETFs by region. If you want, say, Europe-specific ETF, you will see that. And if you want exposure to the global markets, you have good options as well. I will leave the link to the web page, to those web pages in the description box below, so you can always check them out. Now let's get into fees. MER, which is the management expense ratio, is the cost and fees associated with managing the assets in the fund. It is usually charged as a percentage of your portfolio's value, and it is taken directly off the investment return. So you don't have to pay that, it's taken off your investment returns. The lower the MER of an ETF, the better. Vanguard S&P 500 ETF VFV has an expense ratio of 0.08%, while Vanguard US Total Market Index ETF VUN has an expense ratio of 0.15%. Just looking at the numbers like this, you might argue that there isn't a big difference between 0.08 and 0.15, but I beg to differ. Putting these two ETFs side by side, they have very similar holdings. As a matter of fact, the top 10 holdings is exactly the same. This table shows how much you would have paid in fees if you invest $500, $1,000, and $2,000 per month at 10% rate of return for 30 years. The best case scenario is zero fees, right? But that's not possible. Realistically, you would have paid $50,000 more in fees if you invested in VUN with an expense ratio of 0.15% as compared to VFB with an expense ratio of 0.08%. Fees is one thing we can control as investors, and I must say it doesn't make sense for me to invest in a fund and pay higher fees when there is another fund with similar, if not the same holdings, but cheaper fees with the same or even better returns. There is no justification to throw money away like that. If you've gotten some value so far from this video, please click the like button for the algorithm and click the subscribe button below. Thank you for watching. The next thing I will check is the stock exchange that the ETF trades on. And this is important because it determines the currency that the ETF trades in, which then determines exchange rates and fees. Some investors in Canada prefer to buy ETFs listed on Canadian exchange, like the Toronto Stock Exchange TSX, to avoid foreign exchange fees. Some other investors prefer to buy ETFs listed on a US exchange like New York Stock Exchange because the US dollars holds a greater value than the Canadian dollar. And they would rather suck up the fees now while holding investments in a stronger currency. I personally have both CAD and USD accounts and portfolios. A popular example here is the Vanguard S&P 500 Index ETF VFV listed on Toronto Stock Exchange, while Vanguard S&P 500 VOO is listed on New York Stock Exchange. There is no right or wrong answer here. Both ETFs track the same thing. They track the S&P 500 index. And your choice of what to buy between the two is really dependent on whatever currency you wish to hold your investments in. Now to the last criteria, which is the investing platform to use. While I like Vanguard, and a lot of the examples I used here in this video are Vanguard ETFs, the Vanguard platform gives you access to only Vanguard ETFs. BlackRock is very similar as well. You only get the company's funds on their website. If you want a mix and match of ETFs from these brokerages, you can use online platforms like Wealthsimple, Questrade, TD Investing, and the rest. Wealthsimple doesn't have a comprehensive list of all ETFs available on their platform, sadly. So you'll have to search using the ticker symbol of the ETF. There are other considerations when it comes to choosing the right platform, and I can make an entire video on that. But most importantly, the platform needs to be very intuitive. It needs to be an easy to use platform. It needs to have low or zero trading fees, and there has to be availability of dual currency accounts, so you can have open accounts in USD and CAD, and it needs to be an insured platform. So to wrap up this video, when comparing two or more ETFs and to make a fair comparison, the ETFs must have similar goal and benchmark. That's like comparing apples to apples. You can't take a core growth ETF and compare it to a dividend ETF, for example. It doesn't work that way. They're tracking different indices and they have separate objectives. I like this comparison tool from Vanguard that allows you to compare multiple ETFs at the same time. It makes research very easy, and we can run a quick example. For a US total stock market ETF, these ETFs invest in the entire US market, and they typically have a mix of large cap, mid cap, and small cap companies across various sectors in the US economy. All you need to do is to input the ticker symbol of the ETFs, and it pulls up this very nice overview summary. It tells you total net assets, the fees, the 12-month yield, and other basic information. The performance shows what the historic return is, and this gives you a good idea on which is best out of the three in terms of past performance. There is also asset allocation, geographic exposure, top 10 holdings. It's a really cool tool, and you can always use it when you want to decide on what ETF to buy. Watch this video right here where I shared 3 ETFs that meet all those criteria mentioned in this video. And these ETFs are on a constant buy in my portfolio. I pretty much just rinse and repeat the entire process of purchasing on a periodic basis. Thank you for watching. Please share this video with everyone in your community. Together we can get this personal finance message out there, and you'll be shocked at how much people will learn and appreciate this content. Please smash the like button and click the subscribe button to join this growing community. See you in the next one, and cheers to a life of options. Bye.